Equity Market Update, February 2021. The stellar performance of equities continued in February 2021, with Nifty 50 ending the month higher by approximately 6% compared to the previous month. The Nifty 50 reached all-time high during the month post the announcement of growth and capex-focused union budget, good recovery momentum, pick-up in pace of vaccination globally, optimism around additional fiscal deficit by US government, etc. However, it corrected in the last 10 days of the month, driven by the rising concerns of inflation in US, fear of sooner than expected unwinding of monetary stimulus, rise in US Treasury yields, etc. The mid-caps and small caps outperformed large caps during the month. Among sectoral indices, metal, power, banking, oil and gas, and capital goods were best performing sectors, while FMCG, IT, and healthcare underperformed. Global equities performance was also buoyant, with major indices in key countries ending the month in positive. During the month, FPIs bought equity worth $3.5 billion as compared to net inflows of $2.7 billion in the previous month. Cumulative FPI inflows into equity increased to $35.6 billion in 11M FY21 as against net inflows of $9.6 billion in a similar period last year. Domestic equity-oriented mutual funds recorded net outflows of INR 14,901 crore in January 2021 compared to net outflow of INR 18,486 crore a month ago. In the first 10 months of FY21, net outflows from domestic equity-oriented mutual fund schemes was INR 69,217 crore as against net inflows of INR 42,927 crore during the same period last year. Corporate earnings in Q3 FY21 were better than expected and resulted in broad-based earnings upgrades. Results of oil and gas, banks, NBFCs, utilities, metals, consumer staples, auto and consumer durables were better than expected, while those of pharma, infrastructure, and industrials were largely in line with expectations. Notably, Q3 FY21 was one of the best earning quarter in the last 6 years and registered a PAT growth of 31% despite marginal degrowth in revenue. The good growth was driven by better than expected recovery in demand, higher realization, cost rationalization, etc. Specifically, lower provisioning in banks, improvement in execution in infrastructure, higher ARPU in telecom sector, higher spreads in metals, etc. supported the growth in earnings. We expect that some of these factors are likely to sustain over the near to medium term. Further, budget with its focus on growth and capex revival augurs well for new investment cycle and corporate credit growth. Since the lows seen in March 2020, Nifty 50 has risen significantly and has decisively crossed its pre-COVID-19 highs. However, it should be viewed in context that over the past 10 years and 15 years, Nifty 50 returns are approximately 11% CAGR, largely in line with growth in nominal GDP growth. Again, while the rally has been sharp, till 2020 it was relatively polarized, with top 5 stocks accounting for high proportion of returns. In the first 2 months of 2021, the broader market has outperformed but is still lagging Nifty 50 returns compared to the long-term average. An interesting aspect of the market is the considerable divergence in valuations across sectors compared to their long-term averages. The same has been presented in this table. Outlook. As on 28th February 2021, Nifty 50 was trading near 21.6x FY22E and 18.2x FY23E price to earnings ratio. In our view, these are reasonable multiples, especially given the low interest rate environment and improving economic activity. Further, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield stood at 1.5% below its 10-year average of 1.8%. Further, though Nifty 50 has risen significantly, one should be mindful that Nifty 50 returns over the past 10 years are essentially similar to growth in nominal GDP, and also that the rally has been relatively polarized. Considering the above, markets hold promise over the medium to long term in our opinion, and specifically, there is good value in select pockets of the market. Good sequential improvement in economic activity, strong improvement in corporate profitability, lower cost of capital, comfortable external scenario, monetary and fiscal measures undertaken, along with relatively better placed rural economy also supports this optimism. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, significant rise in crude oil prices, higher than expected NPAs post the moratorium, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.